Hello student, welcome back to IBS. Today we are going to discuss about statement of change in stockholder equity. This is also one of the important statement. This is normally prepared by company. So let's jump to the topic and understand it. As you can see, this is the final, I would say, summary sheet to prepare a statement of change in equity. So first of all, this is kind of, I would say, permanent account. As we know, balance sheet account are all are permanent account. Beginning balances. What does it mean? When you are, suppose you are, this one you are preparing for 2024 and last year our ending balance is the beginning balance for 2024. So this is 2023. If you open 2023 balance sheet, in that you will see in the equity section all these things will be available. Common stock will have this much value, preferred stock will have 50k, additional paid in capital is somewhere around 200k, and return earning is 300k, and additional accumulated comprehensive income, as I told you, this is also permanent account. Whatever the changes happen within a year, particular period, that will come here. So that was the changes from last year 2023, whatever the balance they were having, and then they have added the changes in comprehensive income. Then once they have OCI, we can say other comprehensive income, then you will get your accumulated OCI. So that is the value you see here. Then this year total changes in other comprehensive income, as I mentioned, other comprehensive income, that will be 8,000. Like this has been updated. And non-controlling interest is, earlier we were having 2,000. Now we have cash paid for non-controlling interest. So there is two different way we paid. First, we paid cash non-controlling interest to remove their percentage of controlling. Suppose we have a company in which there is co-founder or somebody else whom we are saying non-controlling interest, they are having 20% stake, and we want to reduce their stake. So what we will do, we will pay full and final and remove this, or we will slowly, maybe they are paying cash either for reducing their percentage of share in this business, or they are sharing dividend. This is the income. Whenever the income will generate, automatically the percentage, if they have 20%, so 20% of 90%, 18,000 will be their value, that will be added. And then since it is showing 90,000, so they will reduce their value 80%, they will mention 90,000. Okay, so that amount will come here, 68,000, like this. So since this is not we are discussing right now, so first is dividend, and second we paid normally cash they paid for to reduce their percentage of non-controlling interest. As we can say, treasury stock, when we buy back those stock, common stock we are having thousands of share, common stock we want to reduce, for that we can buy back those kind of stock, so that equity will go down. If the market share is going down, for example, this is the market share, and now if we are here, so that time we are seeing from level our share price is almost 1/2. So this is the right time, because maybe as an owner or founder or management, we know that now whatever we are struggling, that we have a struggle, now we are going to jump. So management know better, so that time they may buy back their share. So that is called treasury stock. When you buy back, so your cash will go, and there you will reduce all those things. How you have issuance of stock, when you are issuing extra stock, so then it is plus. When you are buying back, that another line will come, treasury stock, and there also they will have the treasury stock line item, in that you will reduce. And this is amount, in amount it is coming. There may be one more line, you can update number of share, so that you will have the quantity of share also, what are the quantity they have in common stock, what are the quantity they have in preferred stock. This one will not have the quantity. This is actually when a share being issued, so there maybe share price is $100 and their par value is $10. So $90 will go to this additional paid in capital. So if they have purchased 10 shares, so 10 into 10, 100 will go added here, and 900 will go here. Likewise, this maybe they have one share, maybe 100, then the total share, one share may be total of 300. So whenever one person is purchasing particular share, so their par value is 100. So 100 will go here and 200 will go here. As per this data, we can assume their share price is somewhere around 300 and their par value is $100, and then additional paid in capital will go 200 every share. So this is as per this we can assume. A similar way, preferred stock we have issued. So when they have issued extra stock, so then it will be added. So these are your all old balances. We can club together. One more point to be clear here. Till here to here, we say it till here, excluding non-controlling interest. Till there, if you add together, that will be somewhere around how much, 660. So that value will be considered as an common equity, and then you include this also, and then your amount will be 660, then it will be called as a total equity. So this is the difference between common equity and total equity is non-controlling interest. If you add or reduce non-controlling interest, you will get total equity. Then whatever you buy and sell, accordingly you have to add and delete in this figure. Issue a stock. So maybe you have issued, I'm assuming $1 for one share. So 10,000 stock you have issued. So you have received 3,000 because selling price was $3 per stock and par value was 100. So par value into number of stock will come here, and then the remaining balance will go there. Preferred stock, similarly, whatever the value of per share, that will come here, and additional will come here. Additional paid in CIP adjustment they are adding in case sometime they have some interest expense kind of stuff. Okay, so whenever we issue particular stock, for example, we have issued some of the stock, as we can see 10,000. For issuance, we will be having some kind of cost to do all this kind of activity, like you need to go to investment banking and they will bring new stock, they will do the advertising, they will inform in the market that your share is coming into the market. So all those things they will not do in free, right? They will charge, they will also take some marginal benefit. Whatever your selling price, whatever your stock selling price they have, they might charge 10, 20%, 30%, whatever it is, it has been decided that they will charge per share, they will take it. So those kind of cost, it will be also added back to your additional paid in capital. So this is the total share price and as well as your additional cost incurred to issue this kind of stock, and that all will come into your equity. So let's remove and make it a little bit clean. So now let's summarize this. So let's summarize this common stock, whatever we were having at the end of last year, that will be our opening balance or beginning balance. All will be plotted here. Then till here we will say this is common equity value. After adding this non-controlling interest or minority interest, then you will have total equity value. Whatever you need to, then in the year, whatever you will add or delete, after that also will be considered here. Then after clubbing all together, then this will be your total value. So this side and this side, it should be same. And then adjustment point of view, we will have net income. I have discussed this return earning is, if it is coming into this block, it means this is purely related to this. There is no share of non-controlling interest. Whatever interest will be there, that will not come in return earning. That amount will splitted and directly going to non-controlling interest based on the whatever the percentage they have, that percentage of amount will go there. That will be positive. And when company will pay the similar amount, suppose they got some 10,000 and then they receive 18,000 cash, then they will have zero impact, and then they have paid extra 10,000 to reduce their non-controlling interest or percentage of total out of total company share, then they can pay extra. So then it will come as in minus. Otherwise, if they have any return earning part which is coming into non-controlling based on their percentage of share, and if they have not been paid any cash, so that will be keep on adding here. So it will be keep on increasing. So normally it should increase. Then common stock, whatever you will issue, they will add. Then we will prepare stock, whatever we will issue, new stock that will be added. Then we have additional paid in capital, whatever the difference will come between common stock and preferred stock, whatever the extra people are paying based on share price, that will be coming here. Then adjustment, or as I discussed, maybe that may come in negative, they may come in positive based on the situation. After considering everything, you will have total ending balance. Similar way, your net income will be added to your old return earning, and then you will have total return earning. Then we have other comprehensive income, as we discussed. Whatever thing will not be able to go to income statement, like unearned revenue and foreign currency translation and credit rating kind of stuff. So these are the thing will be coming into other comprehensive income. So this is also permanent account. So these all are permanent account. So that will remain as it is. So that will be called as a accumulated comprehensive income. Then we will add OCI, other comprehensive income. Then it will be added, and then the final figure will come. When these two will club together, this is your net income, right? This is your net income plus you add this. So that will be your statement of comprehensive income, statement of comprehensive, other comprehensive income. So these are the three difference I have already discussed. Then controlling interest discuss. Then you add together this way, this plus this plus this plus this. Okay, like this one plus this one, you might see 30,000, this is 90,000, this is 15 plus 10, 25,000, this is 5,000, this is 30,000. In minus, we have paid the dividend. Dividend paid will be reduced from your retained earning. A similar percentage they should also reduce from non-controlling interest also, because this is, though it is non-controlling interest, but this is somewhere whenever you are generating return earning, they are also keep on increasing when you pay dividend. So similar percentage of their share they will also be reduced, and they will get the cash. And your shareholder or owner, whoever is there, co-founder, owner, investor, they all will get cash also. Likewise, it has been reduced, so there also they will reduce. I have explained this thing in very detailed. Okay, so thanks for watching. See you into the next session. Thank you very much. Just stay tuned.